Hello all. Thank you for making the time today to listen in as we talk about the SA income market. I hope that the information that I shared piques your interest. The South African debt capital markets, if you think about the JSE has an equity exchange. It also has a debt exchange. When I talk about the South African debt capital markets, I'm talking about the debt that's issued through the JSE debt exchange. If we had to look at our world of funding and simplify it in terms of the ecosystem, you've got two basic pillars: your banking system and your institutional investors. And your funding vehicles tend to be debt or equity. So when we look at our private sector, being banks, corporates, and institutions themselves, they tend to have an element of debt and equity in their capital structures. And then from there, you move to your public sector, being your SA sovereign or South African government, your state-owned entities, SOEs, being Eskom and Transnet, and your DFIs or your development financial institutions, such as DBSA, Development Bank of South Africa, or IDC, Industrial Development Corporation. They are debt funded. And then when you move from there to the individuals, being you and me, we tend to have an element of debt funding from our banks. So be it a credit card, vehicle finance, or a home loan. And your debt funding market through your banking system is through loans. So loans that have these standard bank funding agreements behind them into each of your investments. That market is 4.2 trillion in size, and your banks are, their main source of funding is their deposit base. So they have deposits from all of your investments. And interestingly, your SA households make up 25% of that deposit base. And then from there, if you move to your institutions invest in bonds through the JSE debt exchange that I've mentioned. And your issuers that issue those bonds, your corporates, SOEs, have a program. So each of them have their own program, and it tends to be quite a standard program that they then issue their bonds through. And that size of the market is 3.2 trillion. But that includes your SA sovereign. So it includes your government bonds that are issued into the market. And from there, if we look at who is funding your funders, well, it's your investments. If we look at ourselves as an example, we tend to have a bank account that has some cash in it or retirement savings, and that there basically funds your investment vehicles. The other thing to note is while there's no leverage within your institutional base, there is leverage in your banking system. So that is the main difference between the two. Moving from there, if we had to look at a simplified funding structure and ranking, when a corporate kind of starts its debt funding journey, it starts with trade creditors that fund its working capital cycle, and banks that fund the structural assets. So a corporate's a property, plant, and equipment. And from there, you then have your more general funding, which is provided by both your banks and your institutions. And it's in the short term and the long term. In your institutional world, your short-term funding is through your money market funds, and then your longer term is through typically the income space, is in the longer term. And then that is underpinned by your equity. In your funding world, your institutions and your banks all have a standard clause that is called a cross-default clause. It links all of your funding. And this cross-default clause is both a scary concept and it's a structural protection. The scary concept is, if you think about it, it's like a domino effect. So if one funding line falls over because a corporate can't repay that funding line, it then triggers all of the funding lines and they all collapse. And the word collapses in the sense that legally, if all of your funders call the default, the corporate has to then, all of that debt becomes immediately due and payable, and the corporate has to repay it. Feasibly, you can't, no corporate runs on the basis of being able to repay all of its debt immediately. So that is the scary concept. The structural protection that comes in with that is, it's twofold. As a funder into a corporate, as an example, I want to know that if I'm funding something and the corporate is experiencing distress, that it doesn't then subjectively settle some funding and not settle other funding. So if one funding line falls over, all the funding lines fall over, and basically the debt comes to a standstill, and a debt restructure is triggered in the event that there is a solution for the distress that the corporate is in. So that there is a case of avoiding the subjectivity of favored funders. And then beyond that, it is the fact that it brings your funders together in terms of, if there is a solution, they will work towards that solution. So where there is long-term viability for whatever it is that the company does, they look at restructuring the company, and they look at restructuring the debt alongside that company, and they work collaboratively. So that is your structural protection that comes in from there. And that's a nice segue into looking at your defaults and your near defaults in South Africa. So something that we all remember quite well is African Bank as an example. There, your senior debt holders they had to take a 10% haircut on their investments. And this included your corporate depositors and your wholesale depositors. So as an example, City of Cape Town had a 27 million rand deposit with African Bank. They had to take a 2.7 million rand haircut on that deposit. City of Cape Town is also an issuer into your debt capital markets. So that there's a nice, it gives a nice view of the ecosystem of the financial system, basically, and how debt does kind of touches everywhere. And then after that, Steinhoff, we all know quite well as well. Steinhoff, what ended up happening was the fraud allegations came to light, but because there were underlying viable businesses, your bondholders were settled, and your banking sector came in and took that funding offline, basically, to restructure the businesses to see the company through. You had a similar instance with Imperial. Imperial decided to restructure their business, and the debt was restructured alongside it, with your bondholders being settled out. And a more recent example is your City of Tshwane. So City of Tshwane has been placed under administration, which is a technical default under the program that I've mentioned. And there, your funders have signed waivers and standstills to basically give City of Tshwane time to see through the administration process. Other ones that might be less well known are where you've had those restructures and the debt settlements are Omnia, CIG, and Equestra. And then one of the recent ones that has been happening this month is Land Bank. So Land Bank has defaulted on their debt. And there you've got your National Treasury coming in to put in some guarantees to kind of bolster the capital structure, and looking at both a restructure of the business and a restructure of the debt. And that process is currently underway. So moving on from there, when we look at our South African debt capital markets and that 3.2 trillion that I've mentioned, if you look at this journey through time, you will see your SA sovereign, that is the light gray, and then your SOEs, which is the dark gray, and just the growth that has been in that sector over the years. And then from there, when you look at the very bottom of the graph, the dark blue, that is your banks, and that bright blue is your corporates. So this is what the market has looked like over the years. And it doesn't include your bank funding that I've mentioned, that 4.2 trillion. However, banks can invest in these assets, and they do on occasion, where they are looking for specific assets for their Basel requirements. So they can invest through here, and they do invest through here for your SA sovereign. So your SA sovereign being the government bonds that are get issued through here. But let's get to better grips with our South African debt capital markets. And we're going to take a step back in time to the 2008 financial crisis, because that was when quite a bit changed. And if we look at 2008, the total market size was 809 billion versus the 3.2 trillion today. And your SA sovereign then made up 52%, and today it makes up 69%. But the item that I'm wanting to highlight here is your securitizations and your asset-backed programs, which made up 15% in 2008. And today, those are only at 2%. That 15%, your 2008 financial crisis that ended up being triggered in part was due to the securitizations that were taking place in the States. And those securitizations flooded the market and started defaulting. So in that process, your South African market was protected. It was protected because we have exchange control. So you didn't have South African investors going out and investing in US debt and US securitizations. And even though we had securitizations in South Africa, they were less risky than your US securitization. So you didn't end up having any defaults within South Africa. And then moving on from there, your South African trustees actually saw what was playing out in the States, and they started moving away from investing in those assets. So the investments started becoming unprofitable vehicles for the banks to actually run, and that market dried up. And that was how South Africa was protected through the financial crisis. And we also have quite a concentrated banking sector that has been well capitalized through the cycles, and that there was the additional protection. But when we look at this picture, your SA sovereign being the 52% and the 69% sort of distorts the picture. So if we strip that out and we focus on our top 40 issuers into the debt capital markets, excluding the SA sovereign, in 2008, it was they made up 82% of all your issuances at 310 billion. And then 2019, your top 40 is 89% of the market at 860 billion. And the shift to notice over here is your banks went from being 26% of the market to 47% of the market. And that there, after the financial crisis, the Basel requirements that came in, one of the key things was that banks had to raise longer dated funding. So that's what you're seeing over there. And then your state-owned entities ended up having quite big infrastructure rollout. So AXA with the airport upgrades, Eskom with its power plants, and Sanral with the road infrastructure. That journey sort of started after the 2008. And that's what you're seeing over here with your SOEs being at the 29% of your top 40 in 2019. And then corporates caught onto the strategy of funding diversification, and they also started coming into the market. So here you will notice there were only a few corporates that were in the market in 2008. And then when you look at 2019, you'll see a lot more names over there. So what are our concerns at the moment? Well, what is coming? There's a lot of uncertainty. We've seen interest rates being reduced down, a form of easing in light of COVID-19, and that will impact returns in the income space. You've seen a widening in credit spreads. The widening in credit spreads is driven by two fundamentals. The one being that there's less liquidity, and the other being that there is heightened risk and uncertainty. And while South African corporates have generally been quite strong and resilient, there's a lot that's changed, and it's changed very quickly. We've had the oil price collapse, we've had the lockdown and the negative growth, and we've had the sovereign downgrade and the increase in sovereign funding requirements, alongside the fact that funding is going to become more expensive for the sovereign. So there's been a lot of distress that's been introduced into the market, and fragility then builds with that. So what do we look like at the end of 2020? And that is something that we're monitoring on an ongoing basis. What has happened because of the uncertainty is that your debt capital markets have gone offline. And when you look at that, the concern is your banking system is the 4.2 trillion, your institutional system is the 3.2 trillion. When you remove the sovereign, it's 1 trillion. But it's a big market, and if it's gone offline, then it's the concern is you've had auctions being pulled. So in March, you had DBSA pull an auction, you've had Transnet pull an auction, and you've had Resilient pull an auction, because issuers struggle to actually issue when the market goes offline and when there's so much uncertainty. And the last time we had instances of that happening was during the financial crisis and during African bank curatorship. And when you look at the debt that is maturing in our debt capital markets coming up, before the end of June, we've got 13 billion in mostly the corporate space. And then between June and September, you've got 23 billion in your SOE space that is coming up for refinance. We have seen a lot of support coming into the economy within the banking sector, but the thing being that the uncertainty is, well, how big is the hole that has to be plugged? So risks abound across the markets. We're in a low growth environment. Debt is structurally favored over equity, and it's a protection. So while there are short-term risks, is a structural requisite for diversified portfolios. And when we look at the financial system support, in March we had interest rate cuts. We had payment holidays and SARB giving guidance on how to account for the payment holidays from an IFRS 9 perspective. We've had your capital requirements on your banks being relaxed somewhat. And that freed up an additional 61 billion within your banking system to be invested into the economy. And then the SARB also relaxed what they call the LCR, liquidity coverage ratio. They moved that from 100% to 80%. It's basically a bank has to ensure that they can cover their whatever's coming due in terms of their debt in a 12-month period. They've got to cover it 100%. Now they only have to cover it 80%. That, your banking system in South Africa, because it's quite well capitalized, they were already above that 100% requirement by 267 billion rand. So the relaxation from the 100 to the 80 freed up an additional 143 billion. And that was March. If we look at April in terms of the support that's coming in, interest rate cuts again, we've had a 200 billion loan guarantee scheme being announced, where your SA government is going to guarantee bank loans to distressed corporates. And this is actually more effective than your capital requirements that have been relaxed because of the fact that your risk within your bank book has gone up. So even though you've created headroom, some of that has been taken away. This is direct. It doesn't actually impact the capital as much. And then your Prudential Authority has issued a guidance to your banking sector as well, saying no dividends in 2020 and no cash bonuses. And then the other thing is that they're also looking at international funding options. And the reason that that is important is because if they don't source it internationally and they source it locally, it means less funding for everything else locally that requires funding through this distressed market. An interesting thing to note is that your SA sovereign, when they raise their government bonds in the debt capital markets, that those issuances are 15% underwritten by your SA banks. And now with them sourcing funding internationally, that 15% is freed basically for the market. So debt is not without risks, most certainly not in this environment. And there's a lot that's changed. Credit risks have changed. The legal status of debt has not. So it remains a preferred position on a balance sheet. And in a liquidation, your debt holders rank ahead of your equity holders. So if we look at income, it's one word, multiple considerations and instruments. There was a lot of volatility in the month of March. So something that we've done is we've looked at some income instruments over the month of March. Now, an income instrument, I've been talking a lot about debt instruments. It includes your government bonds, but there are also preference shares and property shares, which are also income instruments. And if we look at those specifically, you can see your R186 government bond took a knock of 5% from the beginning of March to mid-April. Property shares growth point down 20%. Nedbank Pref down 26%. And Nedbank subdebt down 4.8%. That's because of, so the government knock is because of the pandemic, the downgrade, and a lack of liquidity, equity, the pandemic and the lockdown. And then your bank pref shares and your bank subdebt is because of the change in the risk environment. And then moving on from there, if we look at your bonds, you've got fixed bonds and you've got floating bonds. Fixed bonds tend to reference a government bond within their interest rate. So basically the way that an interest rate is determined is they reference a government bond and then there's a credit spread attached to that. Your floating notes reference JIBAR, which moves with your interest rate cycle, and then a credit spread on that. And the difference there is evident with what's happened over this volatile period. So when you look at your fixed bonds, your GRT 17 had a 0.3% growth over the period, and its companion bond is the R2023, which was relatively flat over the period. And there was no change in spread there. But then you go to the rest of your bonds, being the GRT 21, the MML 02, and the DSY 03. And all three of those, their companion bond is the R186. So that 5% knock that the R186 took, you can see reflecting in the valuations of those bonds. And then the interesting thing to note is that your DSY 03 also had an increase in spread, a widening in spread, which further negatively impacted the valuation. Then you move to your floating bonds against the same names. So Growth Point, Momentum and Discovery. you had no change in GRT 20, and then you had a widening in spread in your GRT 36, your MML 01 and your DSY 02, and you can see over there that you've had a slight impact on your valuations. But when you look at those movements in your valuations, you can see where they've been quite significant knocks versus where they've been smaller knocks. And when one considers the March volatility, looking at your income performance, it now starts to make sense. And you can see with the Sygnia Enhanced Income Fund being the yellow line in the graph is the mitigation and the volatility that we built into the portfolio. It was one of the aims that we had with the fund, was to minimize the volatility that we saw in the market. And in our portfolio construction, that was basically what we aimed to achieve. So looking at it, we've got investments in low risk government bonds, so SA government debt or SOE government guaranteed debt. Then you've got your low risk corporate bonds, which will include your banks, and that there is your bank deposits and senior bank debt, insurance companies and healthcare companies. So those tend to be defensive through the cycle. And then there are some low, medium risk corporate bonds. So as an example, your retail and property companies while we're in lockdown, and then your unguaranteed SOEs while we're in lockdown. And then those higher risk equity-like exposures are the ones that had a significant amount of volatility. So if we look at something like commodity debt while in lockdown, bank sub-debt and property shares, when you consider those different assets that one can invest in, with our credit selection and our portfolio construction in terms of trying to minimize risks, we kept very limited to no duration or fixed bonds, no preference shares. Our property shares were kept at a very low 2.5%. And we have those floating exposures and strong names and diversification across our exposures. So moving on from there, if we look at income today, our world has changed. As with any investment, income is not without risk. But that doesn't change the fact that funding has been provided to a borrower, and that borrower is legally obliged to pay the funding back in full. So given the current environment, we expect all borrowers to experience a level of distress within their balance sheets and income statements. Historically, where that has played out, we've seen debt restructures alongside business restructures. And we're likely to see an increased amount of restructures going forward as we navigate the changing environment. There will be some corporates that can't be saved. So something like an SA as an example, which is one that is actually playing out at the moment. So risk has increased across all asset types, but the legal rights that income providers hold is a defensive position. And in an increased risk environment, there's value in defense. Thank you all for listening in today. If there are any questions, please send these through to your business development contacts, and I hope that you've enjoyed the content. Thank you.